On today's show, 3 questions. Number 1, what do you need to know about the China deal? Number 2, are we seeing a first class warning sign? And number 3, should I pay off my house early? Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
Lauren?
And I'm Rabih.
Yeah, you are. Yeah, you are, Robbie. Friday the 13th, my people.
Is it?
Yes,
Whoa.
Friday the 13th.
This explains it.
Yeah, this explains a lot. Yes. So excited for another 2 cents. We are officially fully in summer. I love these long days. It's amazing. Guys, it is light at like 5:30 in the morning and it's amazing. I love it so much. It makes getting up early very easy. Lauren, good to have you. I think this is the second 2 cents we've had you. We're going to start bringing you in more regularly. How you feeling?
Oh, feeling good. Feeling good.
Feeling good. She's ready to go. Robbie, we kind of have a sneaky topic we're going to hit. We said, what are we going to, we're going to talk about the China deal. But then before we hopped on, we're like, we probably should talk about what's going on with this Israel and Iran and just at least the impact it's having right now, what we're seeing. But let's first jump into the China deal. I know this is a huge deal of what's going on. It's been making all the headlines. So
Yep,
tell us what's going
100%.
on with that.
Throughout the week, I was preparing for the China deal. I was like, I did my research. I'm going to present it. And last night, a war decided to break out.
Yeah.
And they did not give me a heads up to prepare material for it. I can't believe it.
Dare they?
So
how dare they not? Our 2 cents correspondent must be on vacation.
Honestly, yeah, like couldn't they have chosen a different timing? They didn't take it into consideration. I'm taking it personally, but it's fine. We're gonna hit the war as well. But let's start with the China deal stuff because they've been interesting. And this is before yesterday, that's all what the market has been talking about. And we could see it. The market this week had honestly, it was, if you exclude today, I think we're now net zero on the market for the week. But until yesterday, the market was inching a little bit higher every single day just on the anticipation of this news with the trade deal. And the president went on and said, it's a done deal. So I think it's important, just like we did with the UK deal, to actually look in and see what does it entail? Is it a complete deal? How much money will that bring in? And where do we stand as of now? Okay, so I prepared some data over here. And let's start with saying that this is not a deal, but this is an agreement on a framework. So the US and China met in London and they reached a framework agreement to build up upon the Geneva Truce from May that they've done. It's going to have mutual tariffs on each country. So it's not like we're going to open up borders and remove tariffs. And no, it's actually, they agreed on tariffing each other. And here's what it's going to look like. The framework says that the US will have an aggregate of 55% tariff on Chinese imports. There's the 10% baseline on everyone. There's the 25% that already existed since I think the first Trump term. And then a 20% other stuff related tariffs on top of it. So if you add them, they are 55%. And China will impose a 10% tariff on all American goods. So that is the balance, which is interesting how they got to these numbers. But I think there are more important stuff than just the tariff amount, because the relationship between the US and China, as we've discussed previously on previous podcasts, is different. The goldfish over here is the American consumer. So deciding to put tariffs on Chinese consumers won't really move the needle. China has other cards to play. And one of the most important cards is the rare earth metals. So there is a rare earth provision where it says that China is going to ease export restriction on critical minerals like rare earths, magnets, tungsten, which are vital for U.S. defense and tech. And it is important that this clause is there because China controls 80 to 85% of global processing power for these material. So that is there included. And there's also, the geopolitical stuff. And it's like, can we work together? Can we not work together?
But let's be honest, it was the iPhone that did this, right? It was basically all the stuff we need for the iPhone.
So it is a good deal, but it is still fragile according to like the Wall Street Journal and Reuters, etc. And this is gonna be a good sign before the 90-day expiration of these tariffs shows up next month. Okay, so this is what the news is saying, and I'm like, how does this translate into money for the government? Because we know that the US-China or trade interaction is in a deficit for the US. So we import from China more than China imports from us. 2024 imports from China were $439 billion in goods that are getting imported. So that's money
We brought in from
we
China.
brought in. So we bought $439 billion worth of products and we gave that money to China. That's how you can think of it. And the other way around, China has imported from the US around $143 billion. So definitely a big gap. We're talking about $300 billion
$100 billion,
deficit.
yeah.
That 143 is gonna get taxed at 10%, and those 438 that the US is bringing in are gonna get taxed or tariffed at 55%. So if we do the numbers, this means that probably assuming that the volume of this deficit is not going to change, we're still going to import from each other at the same levels, which is, problematic logically if you think of it. But if we take that as a constant, it seems like the US from 439 billion imports tariffed at 55%, it's going to bring in an estimated revenue of $241 billion to the government.
Problem solved. That's it. That's all we need.
And China's 143 billion at 10% is going to bring $14 billion to the Chinese government. But here's something that we really have to clarify. Those 14 billion are not coming from the US to China. No, this is Chinese government taking it from the Chinese consumers. And the $241 billion that the expected revenue that the government will raise, the US government will raise, it's going to take them from the pockets of the US consumer. And that is in the form of, higher prices on products. So the government is in a tight position monetarily. They need to figure out their budget. They don't like to raise taxes, but they can do a tariff that is equivalent to that. It's more of a sales tax on the US consumer. So this is where we stand. Hopefully that would be one of the ways that the government is able to raise money without it having implications on consumer demand overall. The economy is strong, so if you're telling me that, hey, here's an implicit tax as you on the consumer on what you are spending, the economy is doing good, I might be able to stomach it. We'll see. Time will tell whether it's too much or not.
Well, the point too to bring up, you said this, Rabih, but just to emphasize that there was already that 25% tariff from Trump's first term, right, that Biden kept in place.
Yes.
So there's already been this implicit tax that I don't think anyone noticed, really, if you think about it. Like, I know tariffs have been, the ultimate talk of 2025, on and off. But again, this has already been going on since 2017. Whenever those, I don't know when the exact year, but somewhere in that first term they were put in place, and they've been there. So I'm gonna dare say that people will
They'll
just
go
move on.
unnoticed.
People will just move on. Like, we've already shown that people just keep spending money. I don't think this is gonna stop anyone. I think it comes back to what we said last week, and tell me if I'm wrong. Either one of you, it wouldn't be the first time. But I think it ultimately comes back to nothing to do with tariffs that's gonna impact the consumer. It's as long as the job market stays strong, people are gonna keep spending money. I don't think these tariffs are gonna have any impact on people like, oh, all of a sudden you're not gonna go buy that TV. If you need a TV, you're gonna buy a TV. Football season's coming up in a few months, like, you're gonna buy the TV.
No, I agree. There's a lot of economists going back and forth on what's the impact of those tariffs going to be. Will it show up later because companies have filled up their inventory and we're just using the inventory that was filled up in the last month? The May numbers for the economy came in very encouraging that the US consumer is going to be able to withstand all of what's happening. But let's see June, let's see July. Let's not judge based on 1 month. There is one last point I want to make on this deal regarding China and the US is that this is not a final deal and final sign-offs are required. So the deal hinges on former approval by President Trump and President Xi. And this just tells you that there's still room to wiggle and negotiate and create some.
Wait, there's no worry there. Like, Trump's never gone back on anything. Like, that's a done deal, I'd say. It's based on track record.
Okay.
So Lauren's like, nope, you're an idiot. Lauren, anything you want to add to this at all? Are you not going to buy a TV now, Lauren, because of the tariffs?
Yeah, definitely not.
Yeah, she's like, I'm not spending anything.
Certainly.
Okay, good. That's good. Good update there, Robbie. Let's jump into the kind of a bonus topic being this inconvenient, ill-timed attack
Yep.
that, again, they did not talk to us about this, but kind of breaking news, if you will, of something that just happened with Israel attacking some nuclear sites in Iran and this having an impact on the market. Let's jump into that.
Yeah, it is more politics than it is economics. I was afraid it's going to be economics, but it's looking like it is more politics than it is. Let's just give it a refresher so people understand where we start. The relationship between Israel and Iran has not been on good terms at all. They have two strategic positions that confront each other head to head. Israel has always struggled to find its place in the region, given that it was a new country, as repercussions of the Second World War. It had a war with the Arabs in 1967, where Israel won it. And then they started to prove themselves that they're just going to have a country in that region. Iran, on the other hand, was a capitalist economy, good friend of the US until the 1970s, where they had a religious revolution. And this is where it gets, because this war has a religious dimension to it, unfortunately.
Which is perfect. Let's talk politics and religion here on 2 Cents. I think these are the two.
the 2 cents we need to
These are our
cover.
2 cents on religion and politics. Perfect.
So the new political reason to exist for Iran has been that they are a religious movement across borders that is going to fight evil, and they decided to assign the US and Iran and Israel as their evil. So if you've been
Cool.
So if you've been taunting each other for the last 50 years saying that I want to destroy you because you are evil, and the other one saying I want to destroy you because you are saying you want to destroy me, at some point, it has to blow up. And here it is. So this is what happened. But I think to put these behind us and focus on what is happening currently, it is really about geopolitical influence in the region of the Middle East. The US, since the Obama administration, has been trying to move focus towards the Southeast Asia side of the world, focusing more on China, which created a gap in the Middle East after, the withdrawal from Iraq, etc. So the Iranian kind of filled the gap for a while. That regime started to crack and break after the October 7 attacks that happened, because Hamas, Hezbollah, Houthis are all proxies of Iran. So back then, 2 years ago, it was probably a chess game with the pawns, but now it's a chess game with like checkmates at this point, because the two countries are in direct conflict with one another. Argument is that it is our right to have nuclear weapons, just like any other country, even though if our rhetoric does not align with the rest of what the world likes. And Israel is like, we just survived a not just, but we've survived the Holocaust. We're not going to allow a threat, even if it's far away, to reemerge in our history. So they decided that if they can't agree on a deal for the nuclear weapons, they're going to destroy what is built to create those nuclear weapons.
Which is what just happened, right? The attack was on specific nuclear sites in Iran.
Yeah, this is still very evolving. So we do not know what still remains and what Iranian capabilities remain, and how they're going to retaliate, or whether it's going to stop here. So hopefully we don't have to cover it. But here's where it is interesting, because it's one of the rare times where I'm not in that side of the world. I was here in the US watching this on the news, and I literally just opened the trading dashboard. I was looking at how prices were moving, and it was interesting. Gold went up a little bit, which is an indicator of people are flooding to safety. Those were after hours, so the prices were not 100% accurate. When it opened today, the US dollar strengthened. So all the panic about people trying to leave the US because it's unstable, when actual uh, tension arose and there was a real security threat, money actually flooded back into the US, because the US dollar is a safe haven. And then I think the biggest one of all is oil prices going up. After hours on futures, they rose 12%, which is a big move overnight. But now we're looking at them after they opened, and it's like the crude and the Brent are only up like 4% from where they are. It's still a big move, but it just tells us that maybe the panic is behind us in the oil markets. It's
the
very
panic there, Robbie, just really quick. So the panic there being, if this conflict, if it escalated, it would mess with supply. Is that's the main worry?
Yeah, it's so interesting, because like when we expect a recession to happen, oil prices usually go down. And when we expect that there's going to be really good growth in the economy, oil prices go up. But what should we expect when a war happens? Like this formula breaks down, right?
Yeah.
And I think it really depends on whether the war is happening in a producing country or a consuming country of oil. For example, if something happens in the US and we're a big consumer of oil, you would expect oil prices to go down. But Iran and Israel are both producing countries. Israel of natural gas, Iran of oil. And because they are producing countries, the fact that there's a war happening over there, all air travel has been blocked. I'm guessing ships are not moving around anymore. This is a hit to supply. And when you reduce supply, prices go up. So that is the logic for why oil prices went up. And also because the world still needs to run. So people would try to run towards that commodity, try to bulk up on it just because they do not know whether they're going to have access to it in the future. So oil prices went up. Um, does this mean that they won't continue going up? They might, because if you look at the map of that region, there are certain straits where probably 80% of all the oil goes through these water channels. And those are in between the two countries, and both countries have an ability to disrupt, the movement of the ships and the freight of oil and gas in that region. So they can do more damage, but that would be a big escalation where you're letting the whole world get involved, not just two countries fighting each other. But on the bigger end, it could have been worse, but Iran has been isolated economically for the last 15 years, and they do not really trade a lot with the rest of the world in terms of their oil. They are sanctioned. They only trade with like China and Russia regarding their oil. So the impact of it is minimized simply because they do not do trade to start with.
Got it. Economically, and as you were saying, minimize. We don't know obviously where this goes geopolitically or actual like escalation. The rhetoric coming out of Iran right now is, I think understandably so. They're kind of saying, or I shouldn't say understandably, I think to be expected, they're coming out and saying, we're going to retaliate and in a big way. So obviously more to be seen. Should we just send, I think we're going to send one of our interns out because now we've become war correspondents, political commentators. I think we have a couple interns who just started. We'll probably just send one of them out to the Middle East to kind of report live. And we're just going to kind of shift the show to maybe be a bit more political. Lauren, maybe you'd
Probably.
want to go.
Can't wait. Yeah, sign me
Yeah.
up.
It's like, now we're going to go it live to Lauren there in the Middle East. Okay. That's good update. Anything else from either one of you? Any other comments or thoughts on that update?
So no World War III yet.
No, hopefully not.
The economic impact, I think it's going to be, like I started with what I was saying, I think it's going to be more politics than it is economics. So, yes, it is scary, but unless your portfolio is fully invested in Israeli tech stocks and somehow oil futures, you're fine. You're fine.
I knew my Israeli tech stock tilt was not. I thought it was going to come out strong this year, but clearly not. But since you mentioned gold, I was doing a little gold watch. So not that I have a gold watch. We're going to do a little watch on gold. Year to date, gold is up 28%.
Yep.
For the rolling 12 months, up almost 50%, 48%. So maybe we're eating our words a little bit, Rabih, as we talk about.
No, it's
We've done
fine.
this before.
You're looking at the year-to-date graph. But if you go, and don't tell me how I memorize this, but if you go to the 10-year chart and you look at it compared to US equities, you'll notice that gold is just trying to catch up for all the gains that were done in the last years. So someone who's been invested in gold for the last 10 years probably didn't see any returns for 7 years, kind of flat. And now in the last 3 years, they're just catching up to where equities are. And equities are still on.
Yep. Yeah. Well, and we stand by the fact that, not to make this a gold versus stocks discussion, but we stand by the fact, like, just fundamentally as it is, like gold, it is a different structure from an investment standpoint than investing in businesses, right? Investing in public businesses. Gold doesn't produce anything. It is a pure speculation. So we still stand by that structurally, whether or not you're holding it. Again, over the last year, great. If you are, you're seeing amazing returns. So, okay. Let's jump into, you mentioned air travel, Rabih. Are we seeing a first class warning sign? I saw this article a few days ago and thought it would be interesting to talk about. First, I want to ask you guys, if someone said, what are you bougie with? Like one thing in your life, Rabih, I know your answer, I think. But if you said there's something I'm bougie about, what would you say that is? Lauren, let's start with you. Anything in your life that you're like, yeah, I'm pretty bougie with this.
Oh my gosh. I feel like I'm so cheap. I feel like I'm like Walmart and I
But
don't
is
even
there anything that you're like, if I'm gonna splurge, it's on something, it's on this?
probably shoes. I think
Okay.
I want a good pair of shoes. Maybe
Yeah.
it's 'cause I'm getting old.
That's the ultimate sign of like, I need good shoes for my back.
Or maybe a bed, like mattresses.
Yeah.
Older I get, the more I'm like, shoes, mattress.
We're getting old. We're getting old for sure. Although I do have a good friend of mine who's made a good point about the bed because he's the same way. And he said, look, we spend a third of our life in bed. That's worth spending money on. That's
Yeah.
a good point. Robbie, what about you?
Well, it's food. It
Yeah,
has to be
duh.
food. It has to be fancy, fine dining, where the food has to be so good that I forgot that I just spent $300 on a plate.
Yeah.
But we're
It's like,
not above Wendy's. We still love Wendy's Frosty. I'm pretty sure you still love
was
Wendy's.
that you guys?
This is an inside joke because when I first came to the office, I was like, trying to get the American experience. And the people at work, they're like, you've never had Wendy's Frosty with fries? And I'm like, what is this
Dipping the fries
magic?
in the frosty. Yeah.
Immediately had to
So
go get fries and a Frosty, of
Yep.
course.
just to
Yep.
give you the visual of it, we were in the parking lot of Wendy's. I'm in the middle. They're standing in a circle around of me, and they're looking at my face. And I actually loved it. It's Wendy's fries and
You are officially American in that moment. Yeah.
my
Oh, that's
goodness,
awesome.
yes.
Fine dining is fries and a Frosty.
It's the best. It really is. So I'd say mine, there is a reason I brought this question up because it has to do with this topic. But I would say mine, top of the list is flying. So if I'm going on a trip,
You
if
go first.
like it's an if, like there's obviously some situations where the gap between first class and, basic economy, obviously the gap is too wide. I'm like, I'm not gonna pay 5 times the flight just to do it. But if I can, and if the gap is worth it, like it is something I will spend more money on to fly first class. I just enjoy it. I like being, if it's longer than 2 or 3 hours, I'm also a bigger guy. And so I like having the extra space, but it is definitely something, Lauren, to your point, as I've gotten older, I'm like, this is kind of worth being a little bit bougie about,
Totally.
in my opinion. I enjoy it. I enjoy flying more comfortably. So with that said, that's what this article is really about, is talking about like, is there a warning sign that wealthier travelers are actually pulling back according to reports? And so the indication or the implication here is saying, is this maybe a warning sign for the economy? Kind of a leading indicator, maybe. So this separates out. So this report shows that they're saying high income individuals, anyone making over $150,000 or more, is what they categorize that at. So I'd say pretty much all of our clients saw a 7% step down in growth over the 35 days leading up to the end of May. Basically, just saying they're spending less on flights now. They are saying people below that, they've already started pulling back on air travel and spending ever since the Liberation Day tariffs were announced in April. The lower income or like the below that amount, they were already spending less. But they said the report, so the highest income group went from the best rate, so meaning they were the highest growth rate, like the higher income people were still spending quite a bit of money on flights. They've now gone to the worst. So it's actually dropped where like the higher income people are spending the worst or the least amount on airlines. So the report is saying might be a potential forward indicator because weakness is being seen today in the spend that's probably forward bookings. So basically just people maybe traveling less. I do wonder how this relates, Rabih. Do we, and maybe you don't have this data in front of you, but does it normally translate when we see spikes in oil? Like, is that a pretty quick translation to things like airline tickets or not really?
not really. When oil is down, plane tickets go down. But I think price of oil will affect plane tickets 100%. But what would affect it more and is more receptive to it is demand. So when we started seeing consumer confidence getting weaker at the beginning of this year, and not like January, but more like March, April, actually plane tickets went down a lot. I was doing some traveling, so I noticed how much my flight differed. So it's really receptive to consumer confidence. And consumer confidence is usually related to what is happening out in the world. So there is a relation, but it's not as strong as what consumer confidence is.
Got it. Well, this is actually interesting too. I did not know they track this. It makes sense. There's a key indicator they track called RPK, so it's revenue per kilometer. So for for first and business class flying, revenue per kilometer (RPK), it's calculated by multiplying the number of paying passengers by the distance traveled. It declined by a massive 26.2% year over year in North America. So the global decline was 4.2%. So they're basically, again, they're tracking this as a forward indicator saying the revenue per kilometer is down, go close to 30%. That's a pretty big deal. So remains to be seen. Obviously, we don't know what this looks like. They said airline stocks down. The Dow Jones U.S. Airlines Index down 13% on the year. United and Delta stock are down 11 and 13%. This was as of a few days ago. I don't know where they're at now. American and JetBlue shares are down 30% and 33% for the year. Pretty wild. So airlines are seeing some pretty big drops. So again, remains to be seen. We're not saying this is any true indication of anything, but I thought it was interesting to point out that we're actually seeing less travel. There might be other factors involved there as well, not just like they're trying to make the link, I think, to tariffs, but I'm not sure that's totally true. Any thoughts you guys have on this?
Just
Robbie,
waiting.
you're traveling. No, you're still traveling. It's not
I was
impacting you.
I was traveling. I'm thinking of it from this perspective. While the US consumer is still employed and they're still getting their paycheck, so their spending as a whole is kind of protected, the fact that there is geopolitical risk that causes uncertainty, which makes you pull back on spending, the fact that prices are still expensive. Inflation is, we just got a reading for CPI this week, by the way, but I didn't cover it due to the other stuff that were there. But CPI year over year is 2.3%. So there is still a little bit rise of prices. And just because of the uncertainty, people are trying to, put the wants aside and focus on the needs. And if you start to see a pullback in spending, these are the ones that are going to be hit first. And traveling is at the top of the list because
Always
it's an
top, but
expensive want,
yep.
especially if you're the one traveling.
Yeah,
So it might be one of the few signs. We need it to be consistent and see whether it shows up in the next months and whether it develops a trend or not.
definitely. We'll track this as well. We'll put it on our list of things that we're tracking
Yep.
among the other items. Go ahead, Lauren. You have anything you want to add to this?
Dying to fly Delta one day.
Right?
Have you done it before?
No, well, no, not Delta One. That's like the international.
Yeah.
I've not. Let's see. I did fly first internationally a couple of years ago, like the whole laydown situation. Maybe it was Delta One. Yeah, maybe I did. I don't know all the different like titling, but I did fly internationally first class once, and it was a red eye, and I sprung for the more expensive tickets and slept the whole way. It was absolute heaven. It was absolute heaven.
They
It
get
was the
better
best.
snacks up there. It's a
Yeah.
vibe.
Yeah, it's the best. Like if you, because you compare that to like I've done red eyes like back, let's say back from Hawaii, not flying first class, and you're like upright, and again I'm just always uncomfortable, and I get like the anti-leg syndrome, and I can't stay. I can't handle it. So
I did an international flight where somehow, I don't know how this happened, but I forgot to like pick my seat or something. I was like in like basic comfort all the way in the back, and they picked me in the middle seat. I was nowhere near my family, directly in the middle. And then both my people on either side took my armrest. And I was like, I feel like it should be a rule that if you get the middle seat, you got both the armrests. The
yeah, just
armrests
kind
on
of a
either
thing,
side of you, those are
unspoken.
yours, right? The
I
unspoken
agree.
rule. Don't take your shoes off and give the person
Don't take your shoes off and give the middle person
their
the
space.
armrest.
I literally put my arms on the chair in front of me and just held my arms there the entire flight back. So
Yeah.
I'm right there with you. I should be more bougie about my flight.
I'm just saying, like, you compare, like, I think the gap between that experience versus sitting up first class is wide enough that oftentimes it's worth paying the money. Not always, because again, some of these international flights I've seen, you're literally paying 5, 6, 7 times the cost. It's not that, but I mean, it's worth spending a little extra money, in my opinion. The warning here is once you do it,
You're stuck.
might be this is the ultimate lifestyle creep risk, is like the second you do it, you're in trouble. It's gonna be hard to go back,
Do it
so
with caution.
you do it with caution. So awesome, guys. Let's jump to the last one. Lauren, this is less newsworthy, not necessarily something you got from the news, but I actually like this more. This came from a recent event you went to, this topic. So let's talk about kind of give us the background here of this topic of should I pay off my house early?
Yeah, so I feel like and, you guys could tell me if this happens to you too, but I feel like whenever I tell people that I'm in finance, I feel like at some point they slip in that, like they're like, "Oh, I'm paying extra on my house. I'm paying tons of extra." It happens all the time, and I
Or
feel
how
like
should I invest? Yeah, something like that.
yeah,
Yeah.
yeah, and so anyways, it's a topic that came up where a lot of the people that I was with was talking about, "Oh, like, I'm gonna be debt free so quick. I love Dave Ramsey." They brought in Dave Ramsey, you gotta bring it in, you know? I feel like we're all raised on Dave Ramsey, but they're talking about, being so excited about paying extra to their mortgage and how exciting that is, and I just, like, reflect on that, and I'm like, "Is it better? Is it better?" And so I just feel like the emotional side of it is one thing because I get it. Again, I was raised on Dave Ramsey too, but I feel like when you put the emotional part to the side and you look at the math of it, it tells a different story. And so I did a little bit of math before this, and I was like, okay, if you had a return of like, let's say your mortgage rate was like 5% and you paid $1,000 extra to your mortgage, the most you can get back is 5%, right? And I feel like a lot of people right now too, like that's if you're getting mortgages today, and that's even on the low side, right? But
Yep.
I feel like a lot of people have that like crazy 2.5 or 3%. So it's like if you're paying extra to your mortgage, that's as high as the return that you'll get, right? But over the long term, if you invested in the S&P, it's around 10%. So you can get a 10% return or a 3% return or a 5% return. And I'm kind of like, why not? Because
Yeah.
you get so much more putting it into something else and investing it and still have the opportunity and option of paying off your mortgage if you wanted to.
Yeah.
I feel like even when I show people that math, I feel like they're still like, that feels like fake news.
Yeah. I'm so glad you brought this up, Lauren, because it is such a pertinent topic that
Yeah.
comes up, I think, quite a bit, just from like a principle standpoint, right? Whether this is your mortgage or paying off any level of debt, let's say at the practice or being aggressive with student loans. I think this is an overarching kind of theme in the back of dentists' minds all the time. Should I be paying off? Like, what should I do with my money? Tell me what to do with my hands, kind of thing, right? So I'm glad you brought this up, and I love that you started too with acknowledging the emotional aspect of
Yeah,
this.
it's
Like,
huge.
it's huge. The way you're raised, the lens in which you look through your money, no one can tell you you're wrong. Like, that's just a feeling. No one's going to be like, your feelings are wrong because you were raised on Dave Ramsey. You shouldn't approach debt like this. Like, but then there's, to your point, the spreadsheet answer that I think is worthy of comparing. So I'm going to throw it to Robbie, but one thing I will say, we've talked about this a ton on our stuff when this topic comes up. I think the initial thought that dentists have, or just maybe people have in general, is they think that there's a direct relationship to their stress level or emotional well-being and their debt they have on their balance sheet. And I would actually push back on that notion. I actually think that what comes before that is your liquidity. I actually think liquidity is far more linked to your emotional well-being from what I've gathered. But I want to throw it to Robbie and get his thoughts on that.
I love it. I wanted to hit one thing, but now after I heard you, there's two things I want to hit. The first one is why liquidity is more important than the amount of debt that you have. Because I feel, and this is specifically pertaining to dentists and not anyone else, because if you're a W 2 employee anywhere else, yes, you are looking at your balance sheet as a human being, and being out of debt is a good thing. But once you're a dentist with a practice, with student loans that over there, you have to apply the perspective of a business. And have you seen a business that does not have leverage on its balance sheet? Most businesses, all those that are on the stock market that you're investing in, they have a lot, probably different ratios, but a lot of debt on their balance sheet. And the amount of debt doesn't matter as long as they've got the proper ratios and liquidity metrics to service that debt, because they know they're a business that will bring in more than will come out from the debt. When you're in a business kind of environment, most debt is going to be good debt. But when you're a human and you're thinking of it from the balance sheet of a person, most debt is bad debt. So it's a completely different ballgame at that point, and you have to shift that perspective. But I think it is hard. I think it's something Lauren just mentioned. It's not intuitive. Like, on one hand, you have to look at your mortgage rate and decide if it's low enough that paying it off is not going to be enough. If it's 8%, maybe it makes sense. If your mortgage is 8%, it makes sense. But if it's 2%, it wouldn't make sense. That's the first level of decision making that you have to do. The second level is, okay, so where am I going to get the higher return? Because if you decided to not pay it off and put that money in a high yield savings account, that's not going to be enough return. So there's another level of decision making, which is the asset allocation. And in that situation, you have to take risks. So this whole scheme works out. I think it's a two-step process, which makes it hard, which removes any intuitivity out of it. And that's why, I would not expect to hear that in a conversation, but I would be asked whether I should buy gold or I should pay my mortgage early.
Lauren, I want to get your take on this because you were raised, as you said, Dave Ramsey person. Talk about like your kind of thoughts around this and your journey of as you're saying, like looking at the numbers. But I would imagine, like, what's your first response when someone asks you that? It's probably kind of like, yeah, I feel you. Like, I was a Dave Ramsey person
Yeah.
too. Like the
Yeah.
emotional side of it.
Yeah, I think definitely the emotional side of it, I can definitely speak to that and be like, you at the end of the day, if you're like staying up at night and you're like, I cannot sleep with this debt on my balance sheet. And honestly, there's a lot of times where even though I know the numbers, I like lay up at night too, or being like, oh, like, do I have too much debt? Like I have a mortgage, I am guilty of also laying in bed at night and being like, oh, I don't know. But I feel like, yeah, once I crunch the numbers and look at it, I feel like it just makes sense. And there's so much like exactly what you say when you have liquidity and opportunity. I feel like the opportunity cost in being able to look at it and have an option. Because I feel like once you put the money into the mortgage or the student loans, it's gone, right? And
Yeah.
I feel like having that opportunity brings a little relief as well. Like just
Yeah.
able to have a choice instead of just being like, I already did it. What now? Now that something's come up or, I always feel like just having opportunity like makes a huge difference for me.
Huge. I've called cash just having liquidity, whether it be cash or like in a brokerage account, liquidity as a total, like as a bucket. It's the ultimate change your mind insurance. It gives you that ability to truly change your mind, to pivot to, and I think it's hard to, like Taylor actually said something interesting a couple weeks ago. I thought it was awesome. He said, talking about the same exact topic, he said, you often hear you can't put a price on being debt free. And the response to that is actually you can. You actually can. There's the
Fair for Taylor.
yeah, there's the opportunity cost. If the example you just gave, you're putting $1,000 or $2,000 or $5,000 extra mortgage, we can run the math on that. We actually can. There is an actual true opportunity cost. But I would actually argue the other way around of saying it's hard to put an actual emotional price or benefit to having options, to your point, Lauren, and having that liquidity. So we are big proponents of, first of all, we're not anti-aggressive
No,
debt payoff.
great choice to pay off your mortgage.
Absolutely. And there's a time and a place to do that. I think that's the key. We're more pro thoughtful decisions and kind of like order of operations and sequencing the right thing. So
Don't
if you've
do it out
got,
of fear.
go ahead, Lauren.
Oh, I was just saying, don't do it out of fear, do it out of choice.
Yep. And don't do it because some influencer, shout out Dave Ramsey,
My
just
dad.
said it's the only way to do it.
Yeah.
We're not big on dogmatic approaches in general. Like you have to do it this way or you have to do it that way. Personal finance is more personal than finance. It comes down to your own personal situation, which makes it difficult when you're following, by the way, us included. Like if you're not a client of ours and you're listening to just general kind of approaches we take, it's hard. It's hard to apply that to your individual life. So I'm so glad you brought this up, Lauren. Rabih or Lauren, any other final kind of thoughts on that? Lauren, I'll give you kind of last word on the topic.
Just think, yeah, opportunity cost is everything for sure.
Yeah, I think it's huge. I think that's a good thing to be thinking about is the opportunity cost. I love that you said that. Like that is a true cost in your life that needs to be thought of. So that was awesome, guys. Great. We covered, as always on 2 Cents, we cover a wide range from geopolitical war to opportunity cost and paying down your debt to flying. So I love it. Guys, we got next week, the summit. How you guys feeling? Feeling good?
Can't
Hyped.
wait.
I know. I'm ready. It'll be exciting. So, as we've mentioned many times recently, we love the education piece of our work. We love going around and speaking. Lauren, you just got back speaking in Arizona to a group, and we do this all over the country. If you are out there listening and you're looking for whether you do a study club or you've got a group of dentists that you get together, even if it's an informal study club, and you want speakers to come out and help and share the good word and help with education, this is what we love to do. So you actually can go to dentistadvisors.com/learn, and you can actually submit a request to have us come out and speak to your group. We'd love to do it. So for now, Lauren, Rabih, thanks for being here. Everyone, thanks for listening. That was our 2 cents. Till next time. Bye-bye.